Have you ever wondered how some investors seemingly double or triple their money in a single day? Enter the world of leveraged and inverse ETFs, where returns and risks are supercharged. Before you dive in, know that these financial tools can either be your best friend or your worst nightmare. Welcome to our deep dive into leveraged and inverse ETFs. These aren't your typical investment vehicles. Designed to amplify daily market movements, they can lead to significant gains, but also dramatic losses. Today, we'll break down what these ETFs are, how they function, and why they are particularly misunderstood. So if you're considering them for your portfolio, stick around as we unravel the complexities and help you decide if they're right for you. In this video, you'll learn the ins and outs of how leveraged ETFs aim to multiply daily returns, and how inverse ETFs work to provide returns opposite to their tracked indices. We'll also explore why these are designed for traders, not long-term investors. Discover the risks of volatility decay and how market conditions can impact your investments over time. Get ready to arm yourself with knowledge before you decide to delve into this volatile market. Welcome to the fascinating and intricate world of leveraged and inverse ETFs, where the potential for amplified returns rides the roller coaster of risk. But before we dive into these specialized financial instruments, let's start with a refresher on ETFs themselves. An exchange-traded fund, or ETF, is essentially a collection of stocks or assets that you can trade on the stock exchange, much like a single stock. ETFs can follow a broader market index like the S&P 500 or zero in on specific sectors such as technology or healthcare. They're lauded for their simplicity, affordability, and accessibility, making them a favorite among novice investors. However, when we venture into the realm of leveraged and inverse ETFs, we encounter their more unpredictable cousins. These dynamic instruments are designed to either multiply the daily returns of an index or move inversely to it, providing a range of opportunities and risks that we'll explore next. Now, what are these leveraged ETFs? At their core, leveraged ETFs aim to multiply the daily returns of a particular index or asset. For instance, a 2x ETF seeks to double the asset's daily performance, while a 3x ETF aims to triple it. Consider a scenario where the S&P 500 climbs by 1% in a day. A 3x leveraged S&P ETF would ideally jump by 3% before accounting for fees. But there's a catch. If the S&P falls 1%, that same ETF could plummet by 3%. It's crucial to understand that these are just daily returns. Holding on to these ETFs with expectations of long-term growth might result in disappointing outcomes due to the intricacies of market volatility and compounding effects, which we'll discuss further. Moving on to inverse ETFs, these act contrary to the movements of their target index. They're akin to shorting the market, but in a more accessible form. If an index drops by 1%, an inverse ETF is designed to climb by 1%. For those wanting to double down on their strategic bearish outlooks, leveraged inverse ETFs like 2x or 3x provide additional layers, multiplying the inverse daily performance. This approach can be tempting during market downturns, but understanding its mechanism and inherent risks is critical. Traders often leverage these ETFs for short-term hedging or speculative plays, rather than for long-term investments. They present a unique opportunity to capitalize on quick tactical moves rather than the set-it-and-forget-it investment strategy. Why do some traders choose these high-octane ETFs? The motivations typically fall into three categories: seeking amplified gains during strong market trends, hedging against potential downturns, or engaging in short-term speculation. However, this financial amplifier comes with strings attached. Due to their daily reset nature, which aims to deliver 2x or 3 days of daily changes, they may significantly underperform in the long run due to volatility decay. For instance, over a volatile 3-day stretch where an index goes up 5%, down 5%, and finally remains flat, a 3x leveraged ETF could actually end up losing value instead of breaking even. It's a conundrum rooted in the complex math of percentages and compounding. So what are the pros and cons of leveraged and inverse ETFs? On the plus side, they offer the potential for substantial short-term gains, an efficient method to short markets without delving into options or margin, and generally boast liquidity akin to regular stocks. However, the flip side is daunting. They're not designed for long-term holding, carry high volatility and risk, can underperform over time despite the market siding with your prediction, and come with higher fees than traditional ETFs. Notable examples in this arena include SPXL and SPXS, which track the S&P 500 with a 3x leverage, TQQQ and SQQQ, which do the same for the NASDAQ 100, and UVXY for market volatility, each popular yet risky, particularly for anyone holding beyond a few days. Is a leveraged or inverse ETF right for you? The answer boils down to your investment goals and risk appetite. Are you someone who enjoys the thrill of high-risk, high-reward scenarios, has the time to keep an eye on market fluctuations daily, and prefers trading over investing? If so, these ETFs can be exciting and profitable for short-term strategies. However, if your goal is to build a steady, long-term portfolio, it might be wise to steer clear. They are tools best reserved for specific short-term strategies rather than staple components of a diversified portfolio. If you decide to venture into the realm of leveraged and inverse ETFs, keep these tips in mind. Start small and only use money you can afford to lose. Set stop-loss orders to protect yourself from severe downside. Thoroughly understand what you're trading by reading the ETF's prospectus. And remember, these instruments are tailored for short-term trades, preferably day trades or holds no longer than 1 to 3 days. Ultimately, these ETFs are akin to high-performance sports cars, delivering thrilling experiences but demanding an experienced driver to handle them safely. For those new to the investment world, it's wiser to begin with regular ETFs to build a solid foundation. Then, as your understanding deepens, you can cautiously dip your toes into the leveraged and inverse ETF market. The key is to respect the risks, understand the rules, and trade wisely. So, we've covered a lot of ground today. Leveraged and inverse ETFs are potent tools for traders seeking short-term gains. They multiply daily returns, but come with the risk of significant losses and volatility decay. They reset daily, which can lead to unexpected results over time. Remember, while they offer a way to speculate or hedge against market movements, they're not ideal for long-term holdings. Always read the prospectus and use them wisely. Now that you have a better understanding of leveraged and inverse ETFs, are you ready to give them a try? Or do you think they're too risky for your portfolio? Share your thoughts and experiences in the comments below. And if you found this video helpful, don't forget to like and subscribe for more financial insights and strategies.